Welcome back. So beginning with the first panel discussion of the day, are we heading towards a bubble or is this the beginning of a mega bull run? I will quickly introduce the panelists to you all. Chokalingam Narayanan. Mr. Chokalingam Narayanan has over 17 years of extensive experience in fund management, investment research, and market analysis. He has been instrumental in analyzing business fundamentals to derive relevant and actionable analysis that has portfolio growth. He is consistent analysis of the macroeconomy, financial markets, and ESG that serve as some of the key foundation pillars for the various investment strategies that he has worked with in his career. Our next panelist is Divam Sharma. Mr. Divam Sharma brings over a decade and a half of expertise in managing stock market investments, complemented by his MBA from the Indian School of Business, Hyderabad. He is also a member of the Institute of Chartered Accountants of India. Prior to co-founding Green Portfolio, he gained significant experience working with prominent institutions like Citibank and Kotak Mahindra Bank. Since the company's foundation, Divam has been a key motivator and leader. His responsibilities encompass client management, business development, and research, where he has made significant and influential contributions. Mr. Hitesh Zaveri. Mr. Hitesh joined Axis AMC in 2022 as Senior Vice President and Head of Listed Equity Alternatives. He is responsible for managing the Axis PMS portfolios along with relevant Cat3 AIF strategies. Hitesh has over 25 years of experience in portfolio management, investment banking, and equity research. Prior to joining Axis AMC, he served as head of investments in the PMS business at Aditya Birla Mutual Fund. Hitesh has also worked with ENAM Asset Management as executive director and portfolio manager, and erstwhile Edelweiss Capital as senior vice president and co-head of institutional research. The panel will be moderated by Rakhi Prasad. Ms. Rakhi Prasad is an investment strategist at R4 Family Office. She has 22 plus years of global experience in the field of finance across research, operations, risk management, and investment banking. She has previously worked at Alder Capital, Matrix Partners India, Enam Securities, and Goldman Sachs. She is the founding member of the Women's Investment Network and member of Bloomberg's Women's Buy-Side Network. She was featured in the list of India's top 100 women in finance in 2020 by the Association of International Wealth Management of India. Over to you, Ms. Prasad.
Thank you, Akriti. Welcome all and good afternoon to everyone. It's a privilege to be here on this panel with our esteemed panelists. I'm excited about today's conversation. Since we are talking about are we heading towards a bubble or is this the beginning of a mega bull run? I just want to caveat this by saying that we are not thinking on 25 years. We are thinking more in terms of 1 to 3 years. And especially as being investors that are looking to figure out how to allocate our money. So we will deep dive into this conversation with our panelists, keeping in mind that, the Nifty has given us nearly 25% year-on-year growth, while earnings are also tracking at around 20% if I had to look at the Nifty. So keep all that in context. Welcome all, and I'm going to start this conversation just to kickstart, get everyone warmed up by actually getting very initial quick thoughts. So don't spend more than a minute, panelists. I'll ask you a question if you can just give your quick 1 minute thought so that we can then deep dive into the questions later on. So I'll start with you, Chokalingam, in terms of if you had to think of today's equity markets, what are the first 3 words that come to your mind about Indian equity markets?
Exciting, bottom up enough opportunities, and I think long term there's enough wealth to be made.
Great. Okay. So Divam, over to you in terms of over the course of the next 1 to 3 years, do you see Indian markets rising, stagnating, or falling?
See, we definitely see it rising, considering the kind of growth that we are seeing in the participation. We are seeing the markets expanding overall. We are seeing markets expanding in terms of newer papers coming in and newer, very exciting companies coming in, investor participation increasing, and valuations are not euphoric, or there's no euphoria in terms of valuations. So we are seeing a lot of opportunities in the broader markets at this moment. So definitely it's a structural bull run, and 1 to 3 years definitely looks very positive.
Got it. So I guess we're all very positive so far. Hitesh, you want to give us a contrarian view? Or should I ask you, would you put your own money in the market today, keeping a 1-year time frame, since Divam spoke about 3 years?
Sure. I would, because uh, since I practice, substantial, mainly bottoms up investing, then, you know what are the businesses that you like and the growth trajectory that they're on. And, with kind of valuation orientation that we have, I would feel comfortable in owning a few names, going into next year.
Sure, absolutely. Thank you for that. So back to you, Chokalingam. I'm going to ask you, what are the key factors you would look at to decide whether one should remain overweight, neutral, or underweight on equities in one's overall portfolio, since you find this market very exciting?
It actually depends upon the investor appetite and investor profile, right? What's the investment horizon that they need to look at? So depending upon all those factors, I think advisors could look at what's the right suitable asset allocation for them. And once that's kind of decided, I think if you kind of look at slightly more longer term orientation, because equity is a longer term asset class. It's a higher risk asset class, so one needs to be very long term oriented out here. Because sometimes the returns could be front ended, sometimes it could be back ended. But broadly, I think part is actually we are in a country where the country's balance sheet is reasonably great. We are in a phase where the corporate balance sheets are good. We are in a phase where at the individual level, possibly there are talks about a K-shaped recovery or otherwise, but there is overall there's a decent bottom up. You could find enough pockets where there are opportunities. So when you kind of put all these pieces together, it kind of looks like a pretty decent setup vis-a-vis what's happening across the globe. Geopolitically, we are kind of rightly aligned, in the sense that to both the different sides around, we are reasonably well aligned. In that sense, the opportunities for business, looks quite decent. So it's now more important how we kind of take advantage of this opportunity and how we kind of grow from this. So when you kind of look at that, when we move from a $3.5 trillion to upwards, what we need to look at is for the next trillion, next 2 trillion, next 3 trillion, when we kind of double this for a period of time, what really happens with regards to which are the segments which can really benefit out of this, and bottom up, which are the companies which are doing a good job of it, is what is important. At our end, we practice what is called as the BME philosophy. That's held us in good stead, which basically focuses on business management and valuation. And we are quite happy about following that with discipline. So that's how I would kind of look at the market at this point in time. Yeah.
So, Divam, in terms of, if I'm an investor, right, what should I be tracking in terms of thinking about what could possibly go wrong or even right? So, what do I need to keep in mind while, these markets are being very consolidated or volatile in the near term?
So obviously we are seeing a rally of its kind. Last 1 year has been really great in terms of in terms of the markets. You've seen a lot of people making a lot of money from the markets. So definitely in these type of markets, you see opportunities. Certain opportunities are at very high valuations. Certain uh, low quality opportunities also come to the market and get investor attraction. What we feel is that at this point in time, you have to be very disciplined. It's a stock pickers market, and you need not be very aggressive in terms of your capital allocation. Even at this point in time, our allocation, usually in March, we usually staggered the allocations while buying. In March, we were buying as much as we can last year. But if you look at today, we do not have that many opportunities at our hand in terms of, like, say, if we usually do 15 to 17 stocks allocation in a portfolio, we currently have 7 to 8 or 10 opportunities in the portfolio. Although in the broader markets, there are still stocks which are comfortably valued and which are the story is pretty comfortable. But you need not go with the momentum and just buy everything at any valuation. You have to do your homework. You have to be disciplined. So definitely keeping your head down and just working and just being disciplined is the key, I think in this market. So what could go wrong? There are obviously a lot of things. A lot of geopolitics have been very unpredictable over the last couple of years. We've seen so many things happening across the globe, and a lot of it you cannot predict. A lot of the negatives that could come in from the global markets, and domestic, we are definitely in a momentum, and a momentum of its kind. We always are very surprised to see this kind of a momentum. Like the globe is we are hearing news of recession across the globe, and at this moment we are talking about a 7% plus kind of a GDP growth. I think that is really amazing, and even when you talk to a lot of promoters, the kind of momentum that they are in, I think private capex kicking in could be pretty significant for the economy. We see a lot of electronics or 5G or infrastructure players, or not only the new age type of sectors, defense, etc., but also in the traditional sectors, we are seeing good momentum in the niche, small and mid companies. So definitely a lot of money to be made. We always say that, hey, China is exporting, say, almost $1,100 billion of chemicals to the world. India is exporting just 25 billion of chemicals to the world. Even if we double down to a 50 or a 75 from here, we are talking about $1 billion opportunities for a lot of small and mid players. So definitely the opportunity is definitely there, and that momentum is there. And we are cashing in through government policies, and thankfully a stable government at the center.
So what I'm hearing basically is internally we are all our domestic businesses, balance sheet, government, everything is in the right direction. The negative impact could be largely more from global factors. So Hitesh, you want to elaborate a little bit more in terms of what other areas one should think of or consider while they are investing in equity in this market?
Well, from the if somebody is looking at making investments, and if they are looking, I think one should kind of divide into the what are the positives going into the market, and versus that what are the negatives, and something one should take into account. On the positive side, definitely the correlations between the GDP growth rate and what happens in the mid and small cap, that is very clear. Of course, it's also for the overall market, but that's it's more prominent in mid and small caps. And given that we are looking at around 6.5% or so in terms of compounding over the next 3 to 4 years, So the market is fundamentally healthy, therefore. That is one. Secondly, what really interests us is that how vibrant, dynamic Indian markets are in terms of having some spiral effect. What is happening with automotive, and then then what happens with the ancillaries. And now that automotive, say for example, are straddling both the ICE vehicles and so also the EV vehicles, and then the opportunity then it throws up for the ancillaries, and then the battery players who in turn then want to doing more than the battery business. So the spiral effects are visible in a number of industries. Whatever is happening in banking, of course, in NBFC, in microfinance, and what fintechs brings to the table, and so on. So the positive is, this dynamism of Indian economy, where we are no longer kind of dependent on few. Not that, India was always more broad-based versus a few other markets, but it's getting even better. We are just having number of industries where things are doing very interesting things, and that's a strong positive. Lastly, I think, Raki, that the culture of investing in India is becoming more and more central to our daily life. The number of customers that grow tells us that they have, or many of the other apps, and the obviously the what bigger marker than the SIPs that the mutual funds are getting every month. So I mean, if Indian population begins to systematically properly invest, and as we've witnessed in last maybe 3-4 years, then no amount of, for example, FI selling does affect the Indian market. So some of the great positives. Something one would be concerned all the time in any case is the valuation. How much is the market valuation in the large cap and mid and small cap, and inside of that, let me call them valuation leaders, of course, but the number of companies which would be at least 1.5 standard deviation away higher versus their average, they've just been rising by the month, and there is something to justify. Okay, the earning growth is there to justify part of it, and so on. But sometime in many cases we would see that many times ordinary also gets bidded up along with the good. So that is something I would worry about. I think the other couple of in many of the competing markets, from many of the competing emerging markets, looking to get capital, the valuations are much more attractive. They're substantially more attractive, especially if you look at the banks or automotive and many of the emerging markets outside of India. So it has happened before that the magnitude of selling it, if it crosses some kind of equilibrium, then it can have some subdued effect on Indian markets. And lastly, the geopolitics. What you don't want geopolitics to turn into is, what we saw 2 years ago, which is inflation spiraling, and therefore fears that the interest rates tool would be needed to slow things down, and then that in terms of exit market valuation. So these are the 3 positives and 3 negatives that I see.
Very nice. Thanks for summarizing some of that aspects. Divem, I'm going to on you right now, because you did mention something that typically you would have 15 to 17 stocks in your portfolio, but it's down to 7 to 8. I'm assuming that it's becoming more difficult to find, fair valued businesses. So how are you actually, besides the fact of paring down and making your portfolio even more concentrated, is there any other aspect that one should look at or think of? Have you increased cash, or is there you're just focusing on certain sectors? If you could give some insight into that.
So we have we usually what we do is we create a buy sell hold list, and if there is if there are certain stocks which have run up, we put them in hold list, and the fresh capital that we get, for the fresh capital we have say 7 to 8 stocks in the allocation. Although we are evaluating a few more companies and they would get added, but yeah, definitely we are on the fresh allocation. We are sitting on cash. If you look at our existing holdings, we are seeing some selling opportunities, but there are not many selling opportunities. We still see a lot of value that could be there in the hold companies in the portfolio. So for sure, yes, definitely new allocations, we are sitting on cash at the moment. But we are looking at the broader markets. We are talking to a lot of companies, and we see a lot of value when you go and talk to those companies. like there's a company called if I can talk about companies, there's a company called HFCL which recently we met saw the R&D center of that company. So it was a traditional optic fiber, and then they have set up a very elaborate R&D center. Took people from Siemens, Nokia, Cisco kind of pedigree. Are creating huge strides in 5G, in terms of tower equipment, in terms of routers, in terms of and getting orders from obviously Geo and then a lot of other players. So the kind of innovation that we never used to see earlier. And what additionally very interesting we are seeing is that a lot of companies in SME or small and mid-sized raised capital either through preferential, either through IPO rights. And these companies have been doing expansion, and those expansion, the fruits are reflecting. If you look at like 3 years down, 2 years down, we see huge like growth in the top line, bottom line of these companies which have taken capital from the markets of the last 2 years, and a lot of these companies are there. So the work has increased for sure, but definitely very interesting opportunities, very able, capable promoters we are seeing. And even in the new papers, like if you look at, there are almost 500 companies which are going in for an IPO. I think the markets are expanding, right? So you are seeing very interesting companies coming into the markets, and there is value in some of these companies, and these companies raising capital at this moment, expanding, they could be like huge opportunities going forward. So definitely yes, in the existing markets we are willing to hold it out, but we do not see an euphoria overall that we go and sell the opportunity. We look at it more from a stock perspective than a market perspective. So if we see undervalued opportunities in the stock, we'd go and buy. We'd not look at much of market noise while going and buying these stocks. And we are willing to wait out for the next 2 to 3 years, 5 years kind of a timeline. And that's how we do the allocations.
Okay. So I'm assuming that basically you're not finding enough fairly valued investments, which is why it's down to 7 to 8. Okay, Chokkalingam, I just wanted to check with you since if you could tell us which are those sectors that you're seeing undervalued, fairly valued. I know there will be some few companies here and there who might be overvalued, but generally from a sectoral perspective, what is your view of fairly valued sectors? And then simultaneously, you can also tell us those sectors where you think it's really overvalued and people should stay away.
I think I'll kind of put it into slightly different buckets, right? So the opportunities where things are looking slightly different from what it was say the last decade versus today. I think two big changes have happened. There is shifting of supply chains. One, second, interest rates have kind of moved up. So because of which there's no more free capital available. So businesses which were running with losses are today having to focus on unit economics. So which means a lot of capital intensive businesses today are coming back into flavor. So be it real estate, be it capex intensive businesses, be it financials with balance sheet requirements, or hospitality, or travel, aviation, a whole host of sectors where predominantly, or the traditional core sectors of say energy, metals, cement. There's a whole host of these capital intensive businesses which historically were under earning for at least a good part of the last decade. So today I think that's kind of some amount of pricing power seems to have come back to those particular sectors because of those two factors that I kind of outlined. So earnings growth is kind of coming back. Now, what markets typically tend to, at least what data tells you, is markets tend to like the triangulation of, you create wealth when you get earnings growth, ROE improvement, and get them at the right risk reward. So risk reward is not the only parameter, but it's an important parameter to both earnings growth and ROE improvement. Now, there are 5 themes that we think which are important from as we look into this particular year. there are 5 themes that we are quite excited about. One is urbanization is a mega theme, but within that, real estate is seeing a cycle after a long time. I think that kind of continues for some more time because these are long cycles. Second is government capex in strategic sectors is another area which is happening after a pretty they did it counter cyclical, and that kind of seems to be continuing. And that's something important for the longer term structural health of the economy and the way it's kind of shaping up. Financials, I think the digital backbone that we have in the country is probably one of the most world-class infrastructure that we kind of have, and because of which there's a lot more healthier financial system which is there. Fourth theme that we are quite positive about is experiential consumption. So today people want to consume more experiences rather than goods. So that's something again which is kind of seeing a big change. And fifth, but probably a more underlying theme which is there in everything that's exciting today, is rising energy intensity. So that's again something which is there. It cuts across multiple sectors. So these 5 themes are something that we are excited about. Within these themes, you could kind of see different opportunities which are there and which are not there. But if you were to purely speak of valuations, sectors that are looking quite interesting are probably metals, banking. These are areas, energy. These are areas probably which are quite undervalued. Whole host of sectors are reasonably valued. I think consumer staples after a long time has probably come down in terms of valuations, but is there earnings growth? We're not seeing that. So you have those challenges out there. Some of the other sectors where valuations are punchy, it's actually I wouldn't say more at probably IT as a space looks punchy because earnings growth hasn't come, but valuations look punchy. Some pockets of consumer discretionary look punchy. Some segments of within the PSU space, some parts of it look punchy in terms of valuations for the kind of ROEs that they generate. But I wouldn't put it with a broad brush. There are a lot of PSUs which are also doing well. So one has to be a lot more bottom-up oriented. So that's how we kind of look at it.
Sure. Thanks. Thanks for all those sectors now to deep dive into. Hitesh, over to you in terms of over the next 3 years, where do you think earnings growth for which segments, whether it's thematically or sector-wise, you think is going to perform, keeping in mind India's economy and the global perspective as well, whether exports, commodities, infrastructure, or consumer space? Where do you feel earnings growth will probably outshine the general overall growth of the economy? And if you can just share some of your thoughts.
Right. So, Rakin, in light of your question, I will restrict myself to where the earning growth could shine and do well, devoiding that conversation of the valuations because valuations.
Not talking about valuations, but just earnings, pure earnings growth. Yeah.
Sure. So I think exactly. So I think the capital goods, as a sector, I think will have a strong earning growth. They have been demonstrating pretty good earning growth. So that is looking good. The EMS space, I think the earning growth will continue to look pretty strong. I think that in mid-cap IT, earning growth will be really healthy. So that's a positive. I wouldn't want to broad brush this, but in NBFC, not as a whole, because there are many NBFCs in various stripes and colors and sizes. But there can be, enough and more NBFCs where the earning growth will do well. So, I mean, top of the mind, this and also infrastructure, especially the construction side. I think that the earning growth will be healthy. Defense health earning growth will be healthy. So valuation of all these is a separate conversation.
No, for sure. So essentially then you don't feel consumers are going to be spending enough to show any kind of earnings growth for those companies. Is that what you're trying to say? Our economy is 60% consumption. So
Sure. It's just the base, right? I mean, I'm not saying that, because what I would think, what I would share with you is, where the earning growth seemed to be pretty strong and very high.
Got it.
I mean, not that in the past years, the large cap consumer names, many of them have given high earning growth. And of course, how you want to define consumer, that's a separate point. But let's say so its base effect is only one thing that, plays a role here. Find great companies, great brands, but it depends what is your base effect, even though earning growth can be pretty good. I mean, decent.
So
But they
just
can't rival, but they won't be able to rival in terms of sheer number versus I think, the industry that I named.
so if I have to assume the Nifty or the broad-based market grows in mid-teens level, for example, I mean, we've been
Yes,
seeing that Nifty has been growing in that high teens to 20% level over the last few years, which is actually a great growth rate after a very long time, right?
right.
If we have to think, what do you think would be the market growth rate over the next few years? Would it still sustain at this mid-teen level? And then all these sectors that you mentioned are going to grow faster than that.
I think, if in May, when the elections take place and we have a result which is widely forecasted, if that happens, then I think, the earnings will surprise on the positive side. And by the way, if I can take 2-3 minutes to, point out one, interesting experience. I currently happen to be not in my home base in Mumbai, but I'm in Lucknow right now, and ended up meeting with a lot of bureaucrats over the last couple of days, and the secretaries and so on. And of course, it is just astonishing the way in which, for example, UP government is working to get UP's GDP to $1 trillion. Uh, the details of the plan, the number of industries involved, the number of geographical areas that are involved, um, the measures being taken. And today morning, of course, was lucky enough to go to Ayodhya and then to also Faizabad districts and see some more developments. So, and the states are competing. I mean, talking to this cohort that I spoke with, and then you realize what is also happening in Maharashtra and what state of Maharashtra is doing economically speaking. State of Gujarat, state of Tamil Nadu, which heard praises for what they're doing to grow their industry. Karnataka again. So, as much as we are all very bullish on India's story, but I also love to see and experience and see firsthand what's happening in more of our prominent states, and how are they thinking, and what specifically are they doing to grow the large companies that are present here. And
No,
all of this is going to drive, weaving that back into the point that you're making, Rati, is that, what could happen in FY 25, 26, 27 earnings? Could they be in lower teens or higher teens? My bias will be towards higher teens.
fair enough. That's very positive. 5-7 years of mid-teen growth and higher for Indian economy is very good for our markets for sure. Then the whole question on valuation it will shift towards more stock-specific valuations rather than broader market valuations. Right. I think we have a few minutes left to conclude this session, and I would like to give this opportunity to each one of you to kind of give your concluding remarks, and also maybe you want to pitch your product to our investors. So, which of your products should we be investing in, and keeping a 3-year time frame in mind? If you want to caveat and say that no, I think you should take this product of mine for 1 year, please go ahead and do that. So, I'll start with you, Divan.
So it's an amazing, exciting time for the Indian economy. We saw a very huge capex expenditure over the last few years, and this kind of an expenditure or this kind of infrastructure creation we saw in China in '98 and 2008 post the subprime. So this infrastructure creation momentum is there. The economy momentum is there. I think private capex is going to kick in. So definitely, overall momentum is there in the economy, manufacturing as a theme, and PLI and what we saw post 2020, China plus one and India manufacturing, everything. All these things are going to do pretty well. So we are looking more towards the small and mid cap allocations, very niche players, which are going to be beneficiaries of this theme, and which are not only going to increase India's market share in a lot of these traditional PLI kind of sectors, but also benefit from the kind of consumption that India is going to see going forward. As per a JP Morgan study, India is going to be the largest contributor of middle class population to the world in the next 1 decade. So if you see that kind of a population contribution, you're going to see significant consumption as well domestically. So domestic manufacturing is going to be the key, I think, and that's where we are focusing on small and mid cap niche players, and that's where we see huge growth, and not even like early teens. I think even more than 20% kind of growth could be seen in a lot of these companies which are expanding. So that's where we are focusing, and that's where investors can give us allocations in the small and mid cap space.
Got it. Chokalingam, your turn.
Oh, thank you. I think from our end, we have a broad bouquet of products. So it really depends upon the investor. If the investor has an appetite for small and mid caps, then with a slightly more longer term duration, because the volatility in that particular segment tends to be on the higher end, they need to come in with a slightly more longer term orientation. And for that, we have our flagship, Pike product, which is there. Then if there are style-based investing, then we have our other flagship product, which is Contra, which is out of flavor sectors but leading companies. That orientation is again, pretty well liked by investors. For quality bias customers, investors, we have a product called ACE, and for people who like growth orientation, we have Growth Leaders Fund. And depending on market caps, if they want, then our large cap product or is also there. So we actually have multiple products. So it really depends upon the investor, what sort of investor appetite, horizon, and orientation that they're looking forward to. What suits them is what we would want them to understand with their advisor and then come into it, instead of showcasing just one product. I just want people to understand the product and then come.
Okay, so I'm going to pin it back on you and say, if you had to invest, what type of investor are you? Because you've given all types of profiles here.
So I'm slightly, I like, probably a Contra style of, orientation, but that's me. It's like this business is more like it's like a patient, a drug manufacturer, and a doctor, right? The doctor actually understands the patient better. We are like a pharma manufacturer who manufactures the products. What is suitable to the patient or the investor here, I think the advisor kind of understands it better. So what I like, what suits me may not be the one suitable to everyone.
Absolutely. I know. I was just trying to understand who you are as a profile. But yeah, thanks for the Contra fund pitch. Hitesh, last couple of minutes for you in terms of where would you put your money, in which fund of yours? Yeah.
Well, how I wish I was allowed to put money in my own funds in PMS, but we are, as per regulations, we are not. But having said that, well, we have been so brand equity fund, which is a flagship fund in our PMS offerings. So the advantage of that fund is that it is focuses on brand. It focuses on the B2C brands, B2B brands, B2B2C brands, digital brands, and then what it does is that focuses on companies where the growth momentum, in our view, will be surprising on the upside to the market and so on. In this particular product, our investment philosophy, we are value investors, and portfolio PE needs to be on the lower side. So that is what we are interested in. So the brand, what we think is, what Indian demography has become more prosperous and so on will do is veer towards more brands and take, category after category as versus. We no longer, by the way, hear a terminology which is organized versus unorganized, which is huge there, by the way, out there, but we hear less of it. So at more and more brand driven businesses grow. we think that investors would be in good hand. Once after evaluating the product, if they like, I think that would be one ideal match based on what the advisors tell them.
Thank you so much, all of you, for pitching your product so nicely. I'm sure a lot of our audience would like to follow up with that. But thanks for spending so much time with all of us and sharing your thoughts. It was a pleasure moderating this panel. And thank you, PMS AIF team, for inviting all of us. Over to you, Akriti.